Thanks so much for tuning into this earnings conversation with the management of KPIT Technologies. They came out with a quarter which exceeded Bloomberg estimates. It was a third successive margin raise announced by the company in FY22, and the cash balance, unless my math is completely wrong, has crossed about 1,000 crores, which I believe is the 12th consecutive quarter of increase in net cash. Kishore Patil would be very pleased. Let's get him in to try and talk about whether the company can sustain the growth rates to match the kind of valuations that the market ascribes them, because the past, as we speak, the recent past in particular has been hunky-dory. The question is, can the future be the same? Mr. Patil, great having you. Thanks for joining in. Hope all is safe.
Good morning. Good morning to you.
Yeah. So, Mr. Patil, talk about the quarter, the increase in revenues and the growth that came in. Most people anticipated you to do this, and you've done this for the past couple of quarters. Is there something new that went into this quarter?
I think I would like to give a little bit of a color to the growth during the quarter. The growth, as you know, on a year-on-year basis is 21.2% and 5.6% on quarter-on-quarter. One important part which I would like to mention here is the volume growth is much higher than the reported growth. So if you look at the last year, there is almost a 10 percentile difference between on-site offshore. So in terms of volume, there is almost a 10% additional growth over the year on year, and for the quarter about 3%. And I think from that perspective, the actual, as I said, the volume growth is higher, and that is mainly driven by overall our global clients, but mainly from Europe and Asia. That's where the growth has come during this quarter. For US, we of course have a lot of wins during the quarter, so that's not an area of concern for us. So that's how it looks, and it is certainly led by electrification, which is a global trend. And that's how I would sum it up from this perspective. So to your point, if you really look at the underlying trends, these are for next 4 to 5 years sacrosanct in terms of people accelerating their electrification journey, people accelerating their software spend. And this is something which has been talked by the OEMs themselves through different announcements. It has come through different market reports. It has come through different research by individual players. So overall, this is how we look at it into our universe, which is our clients. So I think we believe that the growth environment is going to be pretty strong for next 4 or 5 years, and maybe later, but at least 4 or 5 years we can see specifically based on the production programs they are taking.
So Patil, just a couple of clarifications. One is you mentioned that the volume growth numbers have looked very strong. What about pricing? And what enabled you to then, therefore, depending on your comment on the pricing, I would want to ask you about what is going behind the margin increase despite the higher attrition?
So I think the key point, as I said, is the movement to offshore, which we have been in a position to do, which is what I mentioned about 10% movement from on-site to offshore, which is the volume growth. So basically, the most of the growth we have been in a position to deliver through remotely. And actually, if you really look at us and look at our commentary last few years, I've been saying that because we are a very specialized domain player, initially, we will always have a good presence in the market, but initially we did it little more than what we would do first, because many of these new technologies were quite new, and it is very hard to get those kind of domain expertise in India. As we were building, I think we built many of these teams outside, and we had mentioned that over the period we could move it offshore. Now, both the pandemic, the mindset change allowed us to do it very quickly during this year. So that's a shift actually which has happened, and that has actually helped us in improving margin. Of course, I won't say it is the only reason. The other reason is, of course, we have been in a position to take more managed projects. Most of them wins are into managed projects, productivity, and basically subsequently rate realizations. These were the few reasons why we have been in a position to do it.
Okay. And now the market will be spoiled by history since you consecutively raised margin guidance for the last 3 quarters. I know you can't do it till eternity, but I'm just trying to think out that with the kind of pulls and pressures around manpower, around pricing, and arguably around rates, where do you reckon a steady state margin picture could be 2 years out? Let's say over the next 24.
3 years back, we mentioned when we were at about 12-13% EBITDA margin, we mentioned that we will get to 18% in 3 years. I'm very happy we reached a little bit ahead of time in 18%. So I'm happy about it. I would say that these are the margins where we would have a stability, because we would like to invest into growth. We would like to naturally, everyone knows about job market. So I would be more comfortable at least for some time. But at the same time, we have mentioned over the next 3 years, we would have the margins between 18 and 20%. That's what also we have mentioned. Now, it really depends upon multiple things like currencies, moments, how it happens, right? It also depends upon how the job market happens, and multiple things in the market. But the fact is, right now, I would be more comfortable at 18% plus, the margins which we have achieved looks comfortable to me. And over the period, we would look at improving that further. But right now, for this year and the next year, I would feel this is a margin we can live with and make investments into growth.
So we won't see another statement that KPIT raises margins for the 4th quarter again next time.
I will be very happy if we could do it, but it looks unlikely because I think.
No, actually, I was trying to wonder if you actually even have margin levers. Would you reinvest that money into growth over margins? That was going to be the question.
Absolutely. We have levers for growth in the margin, and I think we do have. First thing is there are certain areas where I think we have been in a position to have better price realization in some of the complex projects and new offerings which we have introduced. So as the mix changes, I think that will give us some benefit. We have also what we call is we have taken as we get the fixed projects or managed projects, if I have to see, I think we are looking at improving the productivity because the way we have built the tools and infrastructure to improve the productivity, we will get some benefits of that. So there are certain leverages, and of course, the growth always gives some leverage. So there are 2-3 points, and at the same time, I think there are 2-3 areas in which we would like to invest. One is the technology. I think we have been always investing reasonably a high percentage as compared to the company like ourselves into technology building. That we would continue to do. And the second, of course, is the attracting the right talent. So I think these are a couple of areas we would continue to do the investments.
Okay. Mr. Patil, now the key question around growth. The market recognizes the strengths that you have, which is why you enjoy the valuations that you do. At least over the last 6 quarters, there has been a mega shift in the way market perceives your growth story. I'm trying to understand if you reckon that these growth numbers can accelerate going ahead, simply because of the quantum of or the kind of logos that you keep on adding. I know that you've told me in the past that you only want to work with the top 25, top 30 clients. And if I see every quarter, I see a couple of fresh logos getting added, I'm guessing that you're making a bigger and bigger dent into the top 25 market any which ways. So tell us, what is the client addition pace looking like? Are you getting more wallet share from the same clients as well? And is the growth story looking like it will stay? I know you mentioned that it will stay for 5 years, but that is for the industry, I reckon. What about KPIT individually?
Yeah, absolutely. They're the same. I think we are in a great shape, well positioned in terms of the focus. Most important is the focus. The second is the clients which we have, and of course the leadership we enjoy. So that allows us to really tap into the market. So absolutely, overall demand environment and the KPIT has an advantage. And now we have to see how we can maximize that. But to your point, our strategy is about mining the clients. It is about higher wallet share from the same client. These are the clients. Some of these clients are the ones who are spending probably the most number of dollars. And as we have relationships, we are engaged with them. That is the best way to do it. And also, I feel what we feel is it is important to be a strategic partner both ways, right? So it is for us, we are focusing on them and they also feel the same. Then the growth becomes much better and well managed. So that's what is going to be our strategy, and we are not going to go away from that. The only thing what we are trying to do as well is we have created a little separate focus because this T25 is a very clear strategy. And now we are creating a separate focus on what we call as disruptors. We do have some clients in that area, but there are certain types of clients who are challenging the conventional ones. And they are investing a lot of, if I had to say, money into new technologies, and they have, they have no history, so they can try things completely differently. They are looking at different business models. So we would be very, again, careful in picking up some of them, but we would work with them, and we are working with some of them, but we would create a small team which will again focus on top clients in the disruptor space. And this allows us to look at, new breed of players. Some of them may ultimately come as a T25 clients as they grow, may enter into it. Or at least the second thing is what happens is our conventional clients, they are very keen to understand also what the disruptors are trying to do. So it's something we can bring back to them. So from that perspective, this is something, a small focus we have got. And we have still a way to go, but we have put together a team and some strategy we are looking at to really further.
So a large US client added, is that a disruptor or is it an auto OEM, traditional auto OEM? Are you working with disruptors within the Indian landscape, for example, because India seems to have suddenly become a beehive of electric mobility activity as well, maybe not as large, but certainly becoming a hub. What's your sense here? Can you give some color?
I think we look at we would look at generally globally. And of course, every geography we look at if there is such a disruptor coming up or possibility. So we will pick up our list. It won't be like only specific to US. It includes some clients from China. There is a lot of disruption there. I'm sure there is some emerging markets where also there may be one or two disruptors. So we are putting together a list. That's what we are trying to do. But I think the key point is this will not be too small engagements unless we see that this can scale up and they have enough strength. I think that's how we will pick them up. And now mainly as we see is that is our strategy too. We are working with 25 clients. We believe some of them are going to make this transformation for the real automotive change, which is happening in the next 5 years. Some of them may not make it. Then there will be partnership, mergers, acquisition, and some of them may go into disruptors. So we just want to make sure that we have covered our ground on both sides.
Very good. Mr. Patil, just one quick follow-up there. New customer segments. Within OEM or within auto, you are moving away from only the top 25 to disruptors. But what about the other segments, semiconductor companies, 5G telecom companies? Are you getting some material work there? I read it in, I think, either your phone call transcript or one of the notes.
Yeah. So before I answer, I just want to make a small correction. We are not moving away from T25 strategy. It is going to be bread and butter for us. We are just
Yeah, no, what I
balancing
meant is adding
it out.
on.
Yes, we are just balancing it out. So that is a one point. And of course, semiconductor is a playing a very meaningful role. Actually, they have a lot of impact on the automotive industry today and going forward. So they are kind of a partner, alliance partner with us. And of course, some of them can be also a client. But largely, I would say we work with them so that we can provide a much better solution to our end client. That is how we look at it, and it is a win-win for both of us.
Okay. The Goldman Sachs recently came out with a note, and they say that the emerging shift towards more centralized vehicle operating system architectures is expected to yield new deal wins starting Q1 2023. Could you talk a bit about that?
So I think we have been expanding our offerings landscape, and whatever we were doing, and we have been in this field for a long time, so we understand the vehicle architecture and networking much deeper than many other players. And this change in the architecture which is happening, I think we want to play a meaningful role. And with our expertise and the scale, I think we are well positioned. So that is an area which is a kind of a separate unit we have formed to really focus on this opportunity. And that's something which will be a next 5-year opportunity for Scale-up. So that's what we are trying to do. So we see that that will give us long-term business from our current client who are trying to catch up with the changes in the technology and making this transformation quicker. They would require a partner like us, which is very proficient into integration as well as understand the ruggedness as well as the low-level skills which are required for automotive production program.
Okay, one final question, Mr. Patil. Organic revenue growth 18 to 20%. It's certainly not a difficulty. What prompts me to ask my question is also the fact that you've had, in terms of Pathfinder, the willingness to go out and do inorganic moves. I believe some of it was consolidated, a quarter's revenue was consolidated this time, but you also have a large cash balance. And in the past, I think either you or Ravi Pandit have been open about the fact that you are obviously looking at opportunities to enhance skill sets. It will not be for revenue, it will be for skill sets, be that as it may, it brings in some revenue too. So would you reckon that the organic revenue growth for the near term, say FY23, I know you'll give a formal guidance only at the end of the year, but I'm still trying to just figure it out, that 18 to 20% or whatever the number is, organic revenue growth guidance may stay. And on top of that, because of the cash balance that you anyways have, there could be an addition, a cherry on an icing on the cake of the inorganic revenue growth, adding to the luster of growth for you.
So absolutely, I have been very open in saying this, that we will look for acquisition. But the way we look at acquisitions is like this. We have a clear strategy. We have a deep down strategy, what offerings, which areas we are focusing on, etc. In order to accelerate that journey, if we find a right candidate, we will do it. It does not necessarily has to be of a certain scale. Sometimes, like we looked at the Path Partner, it allowed our acceleration of our journey into semiconductor industry. So whatever it allows us to do, that we will take, and that should help us in accelerating our organic growth also. So that's how we have done it well till now, and we are hoping that we are very open and always actively looking at what can help us to get to our strategy quicker.
No, okay. So final question, sorry, but I'm just trying to understand. So you reckon 18 to 20% organic growth based on the current trends, and on top of that, because you're open to inorganic opportunities and you have the balance, cash balance to be able to do that, it could add to the organic growth numbers in the foreseeable future.
So let me tell you that we have not given any guidance for the next year, but we will give it. But the point is,
whatever the number is, yeah,
a good environment, and of course, inorganic will always can come on top of it.
Okay, Fair call. Yeah, sorry, I didn't want to put words in your mouth, of course. But yeah, no, thank you for clarifying that. But great quarter, congratulations, and all the best for the journey ahead this part.
Thank you. Thank you so much.
And the viewers, thanks for tuning in.